Good morning.
Good morning. Oh, where's my
Morning.
Good morning.
Mhm.
Thank you for doing this for us.
Sure.
I'm going to rename myself because I am not Chris. Well, I know I'm looking forward to this. So we get clients off and on that ask about it and might be very useful for me in the future. So,
Good. Well,
and it goes along kind of, we have a few things this year that we're doing that are related to investments or people interested in stuff like that as well. So, I mean, it just fits right in.
great.
And I'm sure we'll probably have a few more people jump on here. Yeah, I mean, I can see people jumping on as we go. So
Yeah.
you know how we are. A few minutes late, a few minutes later or way early to everything.
Well, you just let me know when you're ready for me to get started. And I thought I would intentionally leave maybe 10 or so minutes at the end for questions
Okay,
or just discussion.
okay. And are you going to use any kind of, do you need to screen share or are you just going to be
Yes.
talking?
Yeah, I was going to screen
Okay.
share and run PowerPoint. Yep.
Okay. I'll transfer host to you when we're ready to start. That way you can
Perfect.
screen share. Do we know how to flip my background? That drives me nuts. That lantern is backwards. Anybody know that trick on Zoom? No? I'm just gonna have to deal with it. All right. I'll just try not to look at it. While we're waiting for a few more people to jump on, I'm gonna transfer the host now, just so it's
Okay.
done and ready. But whenever you're ready, I would say just go ahead and jump in.
All right, sounds good. Well, good morning again, everyone. I'm happy to join your meeting today and provide some information and discussion around 1031 exchange. I am Laura Huckaby. I'm in Charlotte, North Carolina. I basically have a dual task in my role. I manage our operations team for the Eastern US, and then I handle sales for the Carolinas and Tennessee. But Old Republic is, of course, a national company. So anything we're discussing today about 1031 is under the federal tax code. So it's applicable in all states. And, you know, you may have some familiarity with the name or the logo because we are part of the bigger enterprise. Ultimately, all rolls under Old Republic International, but probably heard of the name for title insurance, maybe home warranty, but we are exclusively the 1031 exchange division. So I am going to turn off my camera just so I don't get distracted with that. And I will go ahead with the presentation. We're going to roll through some slides, and then at the end, I'm going to definitely have plenty of time for questions, or just if we want to have discussion, open discussion. I'm totally okay with that as well, to go through with anything that you might want to ask. We can ask and cover that. All right. And I should have asked, you can see my screen okay, Melissa? Yes, okay, great. Okay, so what is 1031 exchange? Well, it is a section under the tax code, and it is specific to investment property or business property. So anything we're talking about today, I'd say the biggest first point I always like to make is this is applicable to any type of real estate other than primary residence, because primary residence, as you likely all know, has its own tax code, section 121, that allows taxpayers to exclude gain when they sell their primary residence that they've owned for 2 or more years. So 1031 is specific to investment or business used property. So that could be residential or commercial. And as the definition says, to basically defer or pay no gain on a property, which it is only for real estate now, you have to go through a certain process, which is what someone like our company that's known as a qualified intermediary. We provide the service to go through those steps or that process. But essentially, no gain should be recognized if these steps are followed. And it's, in a nutshell, buying a like kind other investment property, anything other than a primary residence, within a 180-day period. There's, of course, many other details, such as the identification has to happen within 45 days and other facts that we're going to get into. But I guess the big picture is it's selling an investment property, buying an investment property within a 180-day period, and it has to be used for investment or business purpose. So the regulations that govern 1031 exchanges were adopted in 1991. And the reason I mention this is because obviously different market conditions can present. We've come out of this market in which, low inventory, completely a seller's market, high appreciation. And so the timelines, that 180-day period I just mentioned, have been a little more difficult to navigate unless taxpayers have already sort of been seeking and finding their replacement property even before they might enter into the sale. So the regulations basically give what's known as the safe harbor. And again, these are just the steps that have to be followed. So that's what we're here to guide and do. But the key elements of the safe harbor would be that a third-party intermediary is used. So again, that's someone like us, known as the qualified intermediary. We have to be engaged before the sale transaction closes. So that's a really important point or note to recognize if you or an investor you're working with are considering an exchange. You do need to engage the third-party qualified intermediary before the date of close. I've definitely, in many years of doing this, had people call a few days after closing and say they just heard about it, or they decided they did want to pursue an exchange and could we still do it? And unfortunately, we can't. And that's simply because we have to follow these steps that the IRS has outlined for it to be deemed a valid exchange. So anytime after a contract is signed, but before closing, is when you would want to engage with a qualified intermediary like us, so that we can get the necessary paperwork. And the paperwork is essentially what we call an exchange agreement. So that's one of the other safe harbor or key elements, that we have an exchange agreement in place. It's simply like a contract between the taxpayer and the qualified intermediary, spelling out the terms of what we're to do, which is to hold the funds between the sale of the what we call relinquished property and the purchase of the replacement property. Because the third or final main key element or safe harbor is that the taxpayer, so that'd be the seller of the relinquished property, cannot receive the proceeds. So they can't actually touch or hold or control the funds between the time of the sale and the buy of the replacement property. So they can't access those monies. They have to be in control or possession of the qualified intermediary. So let's kind of just talk about what is capital gain. This is something that I think gets a little bit misconceived, or there's notions out there that it's what you might see on the closing statement as the seller's bottom line profit, what you think they're going to walk away with a check at closing. So that's not actually always what capital gain would be. Capital gain is the difference in the value a property is being sold today. So let's put some real numbers to that. Let's say a property is being sold for $500,000 today versus what it was originally bought for. So let's say it was bought for $250,000, maybe, 10 years ago. So the difference in those two numbers is the gain. There are a couple more points in the equation to get the true gain. You have to also take out depreciation, because as long as, property, real estate's held, usually depreciation is taken each year. And then you can add in for improvements. So if, say, you've put a roof on a property, a rental property, you would get to add the cost you paid for that roof to the value. But just simply put, if, let's say in my example, we sold an investment property today, we have a contract for $500,000, paid $250,000 for it. We have taken depreciation, but we've also put in some improvements. So those two things are essentially a wash. So the gain would be $250,000. So that means it's the $250,000 that would, be taxed, would be the amount that the long-term capital gains rate is taxed on. Now I have on this slide, as you can see, that you could have zero profit, but still have gain. And the reason that would be is if somebody's refinanced while they've owned the property, again, coming out of the market we've been in, there's been a lot of appreciation, a lot of equity built into property. So sometimes investors use that to leverage and then pull out those funds to go do things with other properties or use as down payment on other properties. So if, for example, if our $500,000 property that we're selling today has been recently refinanced, there could be maybe a $400,000 loan that's being paid off at closing. So again, that's why if you're just looking at the closing statement and we see then, okay, $400,000 loan being paid off, only netting something under 100,000 as the cash to the seller, it might look like there's not as much gain as there really is. So I would say a key point if you're working with investors is to make sure they've kind of crunched some numbers, maybe talk to their accountant or used a tool like we have on our website where you can calculate your basic gain to understand before they are sitting at closing and looking at that closing statement, how much gain they have in this property. And usually once that's done, it becomes clear that an exchange would likely be beneficial or useful if investor is planning to buy other property. So this screen just shows you a kind of highlight of what the rates are currently. So again, we're talking about federal capital gains because 1031 is federal tax code. So for most taxpayers, 15% is the long-term rate. So this would be for any property that's been owned more than a year. That's where it's the long-term rates. The 20% would be the highest tax bracket. That does change sometimes annually as they adjust what the highest kind of income level of the tax bracket is. I think it's something over 500,000 currently for married couples. So most people in general, it seems, fall in about the 15% long-term rate. And then in some states, which this does vary state to state, there is also state income tax that's part of the equation. So you've got your federal and your state. And then, as I mentioned previously about how you determine gain, any depreciation that's taken. So if in my example, we use that the property has been held 10 years, if it's been depreciated over that 10-year period, when you sell it, there's now a 25% tax on the gain attributable to that depreciation that was taken. And then lastly, there's a 3.8% surtax for most investment transactions. Again, there's some income threshold levels, but in most scenarios with investments, it's going to apply. So you see, if you put all these elements of the equation together, the blended rate between federal and state could be fairly substantial. I mean, it could be anywhere from, 15 to 35% that would be paid on the gain. So, it's pretty easy to see why this is a useful tool, because instead of, striking a check for the tax, 35% on a $250,000 gain is pretty substantial. Instead, that can be rolled into another property if the exchange is done properly, and zero tax is then remitted at that time. I kind of already touched on this, the how-to, but it is, again, how do you determine the gain? It's the selling price minus adjusted basis. And basis, again, is the original price that the property was acquired for when it was purchased, plus any capital improvements that have been put in, minus depreciation. Now, aside here just from how to determine the gain, one other thing I like to point out about an exchange is, as we're talking about gain, to defer it, you do have to buy a property or a combination of properties that are equal or greater in value. So let's come back to my example again. $500,000 is the sales price. It's not just that $250,000 in gain that we're saying that would have to be replaced. It's the $500,000 that has to be replaced, because to keep all things equal, the concept of the exchange is as if a sale is really not occurring. So the way I try to explain it is, if we're selling for $500,000, we've essentially got to get another property or maybe two properties that come back to $500,000. So again, it's almost like we really never sold. We end up with the same value of property. And that's how the gain, that $250,000 gain we're using as an example, is deferred. So I mention that because, again, when people have debt on a property, sometimes they think the debt just sort of goes away. It's not part of the equation, but debt would have to be replaced. Or, sometimes people think it's only the gain that has to be replaced, but it is the value. So just know, if you're working with an investor or talking to someone who's considering an exchange, and this is the beauty of it for, real estate agents, especially if you're in relationship with these investors, is once they sell, they've got to go buy under these certain time frames. So you've got multiple transactions, but just be aware they've got to buy something of equal or greater value in order to defer the gain. So why do people do this? Well, the one that we've just gone through, the equation of how capital gains can be fairly substantial, is kind of the most obvious reason why people do it. But it does allow people to leverage those dollars. It could be $25,000, $30,000 that would be paid in tax. That's enough to be a down payment on another investment property. So it kind of helps keep growing the portfolio. Sometimes it's done to relocate a property. Classic example of that is, we see investors who own property maybe in a college town for a few years, several years, and then decide, hey, we're ready to move away from the college rental and instead now maybe do Airbnb at the coast. So physical location is a reason we see people do exchanges. Sometimes it's going from the passive investment, piece of land that's not really generating anything, to, all right, let's now go buy a commercial property that we're going to have a lease and be collecting monthly rent on. And then just, again, to diversify what's owned within the real estate portfolio. So there's many reasons to do an exchange. Another one that's not often maybe as highlighted, but probably one of the greatest benefits, is for estate planning. The current tax rules allow people to exchange over and over again. There's no limit how many times that you can do that. And ultimately, if someone decides, okay, my real plan is to hold real estate until I die. That's going to be kind of what I pass down to my heirs. The heirs, so that'd be, for example, let's say mom passes away, then daughter would inherit the property from mom at the value it is currently when mom passes. So let's say, mom passes this year, daughter's going to get the property at today's value versus what mom's adjusted basis was in that property. So it's kind of the ultimate way that people do defer on the taxes and keep owning real estate, and can then, pass it along to the next generation. And the tax bill is sort of eliminated since it's received at the current market value. The stepped up basis is what it's called. So here are the 4 methods of exchanging. The most common, which you've probably heard of or maybe worked with clients on, is the delayed, or it's sometimes called, the regular, the standard, the starker. But it's basically when the property, the relinquished property, is being sold first, and then at some point in time within that 180-day period, the identified property is acquired. So there's that 6-month period to complete the exchange, and it's not with the same 2 parties. So in other words, you're selling to someone completely different from who you're buying from. So that's the most traditional type of exchange. That's what we do the bulk of. Another type is simultaneous, which is the same concept. It's just that it's orchestrating closings in a way that the sell and the buy of the new property would actually happen on the same day. So if, for example, like I've said, we've been seeing in recent trends that people want to go find that replacement property early and in advance because they know they'll sell theirs with ease and quickly. They may have already made the offer to purchase, have it all lined up, and schedule it in a way that they close on the sale in the morning and then close on the purchase later in the afternoon. It is required to still use the third-party intermediary with a simultaneous exchange because, again, the taxpayer can't receive or control the funds. So it is still necessary, even if it's going to be a simultaneous or same-day closing and complete it all in one day, to use the qualified intermediary. The other 2 types you see here are a little less common and slightly more complex. A reverse exchange is where the replacement property is acquired before the sale of the relinquished property. This happens sometimes maybe in the context of like an office. If somebody needs to go find the new office space, get relocated, make it their business operational before they've sold the other one, because they need to keep things running smoothly. But the biggest difference in how this method of exchange works is the top 2, the regular delayed exchange and simultaneous. The QI is just stepping in by assignment. We are, again, providing paperwork, an exchange agreement, we're holding the funds, but we're never on deed to the property. The bottom 2, the reverse exchange and the construction or improvement exchange, we actually have to provide a holding entity who does step in and become the title holder. And that's because the taxpayer can't own both at the same time. So obviously, if they're going to go buy the new office first before they've sold, they're still as the vested owner on the deed to the current office. So they can't just go buy the new office in their name and complete the exchange. So that's where it's a little more complex, in that we have to step in and provide the holding entity to be the temporary owner until the relinquished property closes. And it is still just a 180-day time frame to complete it. So that can be, in some instances, challenging. Specifically, it's most challenging in the context of the construction or improvement exchange. And that's when the taxpayer is trying to take proceeds to apply towards improvements, towards maybe upfitting an office or restaurant, or adding a roof, or renovating a rental home. So in other words, instead of just getting that property for its current market value, their taxpayers trying to utilize proceeds to maybe put 50 or 100,000 or more, whatever is feasible, into the property. So again, for that amount of improvement cost to be built in and become part of the replacement property value, we would have to step in and hold title, and then invoices get submitted for payment of those construction costs within the 180-day period. So then by 180-day exchange period end, we would come off title, and the taxpayer would then receive the property at the original cost. It was, per the contract, what they paid for it or what we stepped in and held it for, plus all the invoices paid for construction. So maybe someone buys a piece of land for $200,000, plans to build a warehouse. So within the 180 days, we send out funds to do the foundation, the framing, the roof. And so by day 180, instead of the taxpayer getting just the $200,000 piece of land that they would have received, they now receive, let's say, a $400,000 property that's the land plus that warehouse that they were constructing within the exchange period. So I guess the key takeaway here about the methods of exchanging, the top two are the common type, simpler and less expensive. The bottom two are, of course, possible, need more time to orchestrate, and a little more costly because of what's involved. So this is just a picture that delineates the timeline of the most common, the delayed exchange. So closing on the sale, the relinquished property, is what sets forth the deadlines. So from the date of close, the taxpayer has 45 days to identify their list of potential replacement property and 180 days to complete purchase of one or more of those identified properties. Of course, I get questions very frequently as to, are there extensions for these deadlines? No, unfortunately, there's not. The IRS doesn't let the taxpayer just ask like you're able to for filing your tax return. You're not able to ask for an extension on these deadlines. The only exception is when there is a presidentially declared disaster. And actually, we've recently had some of those with hurricanes, flooding, winter storms. The IRS will put out bulletins, and in that affected area, it could be certain counties or certain states, they may give some extra time on tax deadlines, of which exchange deadlines would fall under. So that's the only occasion where there would be extension to those. Another common question I hear is, well, what happens if all of the properties that we make offers on are no longer available, or we can't come to terms, price, etc., and we're past our 45 days? Can we change them, substitute? Unfortunately, no. So these deadlines are really important because there's really no wiggle room. And that's why, going back to the fact that the rules we follow today were established in 1991 under the current market conditions and challenges that people are faced with, it can be quite difficult to get contracts negotiated and things closed within these timeframes. But advanced planning helps to know that that's what needs to happen, and that's why it is okay to be making offers, and they could be contingent or putting down earnest money and getting the replacement property lined up so that that's already underway before the actual clock here starts from the date of closing. There are specific rules for identification. The most common is the 3 property rule. This allows the taxpayer to identify up to 3 properties of any value. So if they sell for $500,000, they could identify 3 properties that are each $1 million. There's no limit on the value but there is a limit of only identifying 3. So that's most commonly used if somebody's selling one and planning to replace it with one of equal value. The 200% rule, which is an alternative. So again, I want to emphasize, you don't have to use all of these rules in conjunction. It's either or, you're choosing which rule. The 200% rule is used if you're trying to identify more than 3. And in that case, the limitation is on value. So the total value of everything identified, let's say 5 properties are identified, the total value of all 5 cannot exceed 2 times the value sold. So if someone sells for $1 million, 2 times $1 million is $2 million. They could identify any combination of properties that together, all of those properties identified do not exceed 2 million. And then they choose out of all that are on that list, which ones they buy. They still just need to replace up to $1 million since they sold for $1 million. So we see the 200% rule used typically if someone is going from a higher valued property and looking to split it out and diversify, maybe by a combination of smaller valued properties. The 95% rule is an exception. It's very rarely used. And the reason is that you can identify any number, any value, but have to acquire 95% of the values identified. So usually if people are looking to identify many and of any value, they're most likely not looking to buy almost all of them. So the only example I can share where I saw this utilized and it worked was where a farmer was assembling several parcels to put together a new farm and had already bought 10 parcels within the 45-day window and only had one more to buy. So obviously in total, the 11 parcels, 11 properties, way exceeded the 3 property rule. In value, it exceeded the total 200% of what they had sold. So it did only leave the 95 exception, but it worked because they had already closed 10 of the 11. They had a contract already on the 11th parcel. And so they ultimately did close and acquire everything. Just a few more points here on identification because it is very important. It does have to be in writing. So a lot of times we get calls from people as they're near, honing in on their 45th deadline saying, what do I have to do? Can I just send you an email? Well, no, the definition of in writing under the Treasury regulations does mean it has to be a signed and dated document. So that's why just typing up an email saying, I'm looking at 123 Main Street is not sufficient. We do provide a form that tries to help make this process simpler, where the taxpayer can just fill in the address, sign and date it, and then they can scan by email or fax the form back. And that meets the in writing because the key again is that it is signed and dated. And it does have to be delivered to us, the intermediary, or someone that's not disqualified. So for example, if you as their real estate agent is working with them, they couldn't just on day 45 hand you their list of properties because you were technically working for them. You're deemed their agent as defined under the tax rules. So, handing you a list would not meet the requirement. So vast majority of the time people do just submit to us, and that's the best practice because then it's easy to track and prove that they did it timely and to the right party. And then we have to rely on it as we move forward with the exchange to be sure that what they're going to buy as their replacement property is what was identified. And again, it has to be signed and dated by all taxpayers. I do mention that because as we all know, we hear people or somebody's on vacation or the wife's out of the country on business. But if whoever entered into the exchange, let's say it's a husband and wife, both would need to sign for proper identification. So, one spouse can't sign for both. Likewise, if it's like an LLC or a corporation, whoever is deemed the authority to sign for that particular entity, all have to sign and date. And then if changes are needed with identification, it can be revoked. So the identification, if it's submitted within the 45-day period, let's say maybe 2 weeks in, they find a great property, go ahead and identify it. But then 2 weeks later, discover there's problems and they want to revoke and change. That is allowable so long as it is within the 45-day period and it is done in writing. So the same way they've submitted and said, I'm identifying 123 Main Street, would send back a form scratching it off saying, I'm not identifying 123 Main Street. I now want 456 Main Street. So that can be done within the 45-day period. I like to always highlight that like kind is a broad definition. So there's, again, some notion out, I think, in the world that like kind, if you're selling, say, a rental condo, that you have to go buy a rental condo. Well, it's not that narrow. It's actually any type of property held for investment. So here's just a few examples. Could be a single family rental and go buy commercial, vice versa. It could be a medical office building and then go buy a shopping center. So as long as it's real estate held for investment purpose, then it meets that like kind definition. So I'm going to just talk about a few of the common, hazards or potential problems that people encounter. One is what we've mentioned or discussed about deadlines. Just meeting those deadlines can be challenging, but that's a pretty commonly discussed upfront known thing, 45 days, 180 days. Other issues that arise that are a little less common are things such as how the property is held. So we call it the same taxpayer. So the taxpayer, whoever is on the deed to the investment property being sold, is who has to acquire the new property. So common examples of how this could become problematic would be if someone owns a property, let's say I owned a property prior to marriage, and I've held that property and it's been investment, and now I'm ready to sell, exchange it, and go buy an upgrade. Well, it doesn't belong to my husband per se, because from a tax standpoint, it was my sole separate property before marriage, and I was the only one ever on the deed. So when I go sell it now today and do the exchange would still be just in my name. Of course, I know in North Carolina and other states, spouse has to sign off on the deed to convey for marital interest, but from a tax perspective, it is based upon ownership, record ownership on the deed. So what we'll encounter, or how this plays out to be slightly problematic, is, let's say the property I'm selling that I'm saying I'm upgrading, I'm wanting to go buy a, much larger beach property. And to qualify, since I'm trading up in value, I need my husband's income to get a loan. And so that's where it can be problematic, because then obviously the lender wants us both on the property, not just me. There are ways that the husband and wife situation can be dealt with, but it's just something to kind of note if you're working with investors and find out maybe somebody owned a handful of properties before they were married. Same thing holds true with partnership interest, LLCs, corporations. Classic, what we see happen all the time is if it's, say, a medical practice that maybe the doctors owned their building and now they're selling, and 2 of the 3 do want to exchange, but 1 doesn't. Well, if they've owned it under an LLC, and the LLC is who's on the deed to the property, it's the LLC that would have to complete the exchange. So they don't really have the option to sort of go separate ways and let 2 exchange and 1 not, because in the eyes of the IRS, the LLC is kind of the single taxpayer. Again, there's some advanced planning tips if you encounter this type of situation in advance that I've got information we can share, but partnership distributions can occur in advance and break it up and let people kind of jump into a tenant in common type ownership. But it has to be addressed and known in advance of the transaction. You know, it can't be the day before closing to get that orchestrated. Seller carryback financing, that arises occasionally, that sellers want to offer, you know, financing to help get the deal done. Generally, if the seller's going to hold a note, that note's likely not going to be part of the exchange because they're going to receive payments over a number of some years. So that means that portion is probably going to be taxable. So if you've got somebody looking to sell an investment property and saying, hey, I think I'll just agree to carry a small note, they should just, you know, be aware that that component is likely not going to be deferred as part of the exchange. Repairs, we often have people ask, can we, you know, net out the cost for repairs? Well, the way the IRS defines it, repairs are not considered an allowable expense. That's more of like maintenance or upkeep. So netting that out and not replacing costs related to repairs would most likely result in some tax consequence. And again, that's kind of making the distinction of a repair versus an improvement. An improvement is something that's enhancing or prolonging the life of the property, and that is going into the basis. But a repair is generally, you know, overdue maintenance or something that's broken. And so that's why it's kind of categorized differently. Related party transactions, they do come up quite frequently, and they are a little bit problematic because the IRS tends to scrutinize family transactions with exchanges. And the reason is they see it as potentially shifting of basis, that, you know, maybe brother and sister are going to sell one another a property and it's not at fair market value, or one is, you know, going to buy from brother as part of a replacement property in the exchange. And again, it's shifting basis for sister. And so there's just some detailed caveat guidance on related parties. So instead of taking a deep dive, I would just say if you encounter clients who are asking, you know, could I buy or sell from a family member? Again, I'd point them to somebody like us or their accountant. We can share some information that goes over in more detail, you know, what the rules are. And sometimes it's just as simple as saying, well, you could, but there's a risk that if you're audited, the IRS might disallow it. They may not like it. We've already touched on the same taxpayer. And then the holding requirement here, this is something that I think is a really important point to understand. Big distinction with exchanges versus like flips. Because a lot of times you think, okay, investors, so whether they're flipping or holding property, they're considered investors. But the definition under Section 1031 emphasizes that it is property held for investment. There is no magical time period, so I can't really say, oh, if you hold it for a year, it definitely qualifies. There's been tax court cases where property was held less than a year that they allowed, said, okay, it meets the basic held, the intent was there, and then some circumstance is what caused it to be owned for a short period. There's been court cases where property was held for a few years and still found to not really meet that holding requirement because the entire time that the property was owned, it was really intended to just be sold. So flipping, you know, technically again does not really qualify because that is intent to buy a property, fix it up, turn around and sell it, versus holding longer term where the intent is to rent it or, you know, run a business out of it or farm on the property, or it could be just holding it for unproductive use, but then, you know, for some length of time. But certainly intent of holding versus turning around and selling it is, I guess, the key distinction there we would make. This slide just kind of goes into a little bit more about what is boot. And boot is just a funny accounting term that's anything that comes out of a transaction, whether it's cash proceeds or debt, not put back into the next property. So again, just kind of putting it simply, if a $500,000 property is sold and then only a $400,000 replacement property is acquired, you can see there's a difference there of $100,000. And so that would be what is the boot resulting. And so that's the amount then that would be subject to gain. So, if the question arises, can a partial exchange be done? Or if I don't buy a full value replacement property, is it, okay? And the answer is yes to that. It's just that you have to kind of analyze, or the taxpayer does, at what point, is it beneficial? Because in some instances, a partial exchange, if there's enough boot coming out that's subject to tax, it could be equivalent to the gain, and then it would not be worthwhile. But if somebody has a very high gain property, maybe they've owned it for 25 years, so it's almost all gain, or it is all gain, then taking out a portion and paying tax on that portion still makes sense. So it is allowable to do a partial exchange. And actually, here's my slide. Oops, let me go back one that we just touched on about the difference in holding. Qualified use is the term under the tax code. Kind of the distinctions again about flipping and the intent. So it's really a three-prong approach. The length of time is one, even though the IRS has never fully defined what is the length. Most tax practitioners suggest a year, or definitely 2 years is better. But, again, intent, circumstances, and time. Those are the three key elements there. How long the property's been owned, what the intent was when it was acquired, and what circumstances have changed. So, for example, one of these cases, it's a scenario where it was owned for a short period, but it was because an unsolicited offer came along and the taxpayer had full intent of holding the property long term. So, if it's a leased property and it's definitely intended for that, but then something happens and this offer is made and they're not intending to sell it, but it just so happens they do, that's kind of one of these fact patterns where it's hard to say what length of time, because it's also intent and circumstances. This is just, again, a quick summary of what the qualified intermediary, what we do. So again, it's really a combination of document preparation and coordination of the transactions. We're trying to give guidance and be a technical resource throughout the exchange process. We do actually review and sign off on some closing documents, primarily the closing statements. And then we hold the funds between the sell and the buy. And then we just kind of act as a coordinator and consultant with the parties involved with the transaction. And we track the deadlines and do a lot of communication along the way to keep the client on track with that. Very important to understand when working with an investor client and choosing the third-party intermediary, you don't want to just say, well, let's ask about their fee. There's other key important things to be thoughtful of, such as, experience. Are the documents and everything up to date? Are they going to give some level of expertise and knowledge when you call to ask a question? And then financial security, stability of those funds. It's really an unregulated industry. And what I mean by that is qualified intermediaries, we have to follow the Treasury regulation safe harbors. But unlike the mortgage industry, for example, where there's all these regulations and licensing and audit, things that are being constantly monitored and watched, there's nothing that says who or how this has to be done. So technically, most anybody could be a qualified intermediary. You could ask your next door neighbor to do it, because then you're not holding the funds, and you could write up some simple agreement. But obviously with that becomes the financial piece. whoever is holding the funds is in control of those funds, and there has been fraud. There's an American Greed episode that we always usually get a few calls after it airs, because there was a 1031 company that definitely frauded people, took a large amount of money, and it caused a lot of harm. So I just mentioned that to say, make sure when you or your client are considering who they're going to work with as the QI, that there are some security and stabilities there within that company. We carry 120 million in fidelity bond, 50 million in errors and omissions, and then being part of Old Republic International. You can look up the financials and it's pretty clear, what kind of financial stability we have. So it's important to ask those questions in addition to just, what does it cost? Because some people can offer a little bit lower fee, but they have zero bond and E&O in place. And that sort of wraps up what I was going to cover, but I'll be happy to answer any questions or address any points that maybe I overlooked or wasn't clear on.
Hi, Laura. Good morning.
Hi.
Did you mention that you can buy more than one property after closing? I mean, yes?
Yes. So if you reflect back on where we talked about identification. So again, if you could identify up to 3 of any value, sometimes people, again, a great benefit would be, let's take those proceeds, let's use it as a down payment, and now go buy 2 or 3 properties. And that way you're going to have more income coming in from multiple properties. So you're not limited to just buying one. If you've sold one, you can take those proceeds, divvy it up, and go buy more than one to replace the one. It's just all about balancing the numbers in the sense that you want to get back to the total value. Does that make sense?
Yeah, very good. And you mentioned also that flipping is not part of 1031 exchange?
Correct.
Okay. Another question. What's the best you can do tax-wise to already close one property and you already bought one within the 180 days?
I'm not sure I understand your question. You're saying, was an exchange not utilized?
Exactly. Exactly.
Well, you would just have to run the kind of gain calculation and see what the gain is. But unfortunately, if the exchange was not utilized, then I think even if, you're buying another property, you're still going to have to recognize the gain in the one sold if the exchange was not kind of set up and in place. But, again, you just have to calculate what is the adjusted basis, therefore what's the gain. And then it would be anywhere from the 15 to, 30, 35%, depending on federal and what state would be the percent that's paid on that gain amount.
Okay. Lastly, when you go buying the property, the proof of fund that you give them, I guess, is the
Identification.
Yeah.
Mm-hmm.
So the proof of fund would be the contract that we have with you?
So the exchange agreement is what has to be in place by the date of the sale closing. And again, that's like the contract between the taxpayer and us. Then we receive the proceeds and the exchange deadlines begin from that date. The identification form is separate and it's completed anytime within that 45-day period. And so if somebody's using our service, for example, we're going to give them that identification form up front. They have it readily available for use and they can fill it out, sign date, and return it anytime, but no later than the 45th deadline. So it is separate than the exchange agreement. And there are other ways to identify. I mean, it could be that a signed contract with a seller that states it's going to be a 1031 exchange is identification. Or any property that's acquired within the 45-day time period, acquiring would be the purest way to identify. Because
Very
there's no
good.
question it was identified if it's acquired.
Okay, and what are your dues? What do you guys charge to do this service?
Right, so fees for us with the standard delayed exchange, the most common type range from about $950 up to $1,500 for the relinquished transaction. And that range is basically whether we're talking under 500,000, over $1 million, or over 2 million. And then there's some bank wire charges. So yeah, it basically starts at $950 and goes usually no more than around $1,600 to $2,000. If it's a reverse exchange that I mentioned, that's more complex because we have to park title with those, the fee on those is a good bit more. They're more in like the $8,000 or $9,000 range.
All right, thank you so much.
Sure. Any other questions from the group?
I think you did a pretty good job of covering about everything.
Okay, I know it can be a lot. So as I mentioned, our website has a lot of great tools. I have articles on a lot of the different topics. So, it's something you don't encounter often, but it's what I do every day. So I think having my contact information is likely one of the most helpful things. So the next time somebody asks you a question or considers it, you know where to turn.
Yeah, a lot of great information. I mean, I have notes on just about everything you went over. So
Great. Great. Well, please do let me know if I can be of service or help to you and your clients in the future.
absolutely. Anybody else have any other questions, or everybody's good?
All right.
Okay. Well, I appreciate it. I mean, I'm definitely keeping you in my contacts for sure.
Well, thank you. I appreciate it. I'm just checking the chat here, but thanks everybody for your attentiveness today, and hope to hear from some of you soon for an exchange.
Thank you, thank you.
All right. Take care. Have a good day.
Sarah, this is Sabine. I have a question. I couldn't unmute myself. You mentioned something about the 200%. Can you explain that a little bit?
Yes, I can. 200% is when identifying it would be more than 3 properties. So in other words, they're looking to identify 4 or more, but the limitation is 2 times the value of the property sold. So I think the example I used, and this kind of easy math to think of, is if the property sold is $1 million, then 200% for identification would allow up to 2 million total in property to be identified. So it could be any number of properties. It could be 4, 5, 10, but together, all of those properties, fair market value collectively could not exceed 2 million, since that's 2 times the value of the property sold.
Okay, thank you.
Uh-huh. All right.
All right, Laura, thank you so much again.
You're
I
welcome.
really appreciate it.
No problem. Happy to do it. All right. Well, have a great day.
You too. Thank you.
Bye-bye.
Thank you.